Hello financial fans, welcome back to another stock analysis. Today we'll be covering Qualcomm stock ticker QCOM. Qualcomm is a multinational technology company that specializes in the development of advanced wireless technologies, including hardware components like processors, modems, and wireless radio modules, as well as software and the other technologies that enhance wireless communications. They are known for their expertise in 5G technology and have played a key role in driving the global adoption of 5G networks. By enabling faster, more reliable, and more efficient wireless communication, Qualcomm is helping to shape the future of mobile industry and support a wide range of applications and services. The company is currently sitting at a market cap of $138.7 billion, and in 2022, they generated a revenue of $44.2 billion, and the dividend yield is a nice 2.44% currently. 56% of the revenue comes from handsets, 11% from radio, 14% from Internet of Things, 2% from automotive, and the remaining 17% from licensing. To determine the final valuation of the company, we'll be using a margin of safety. The margin of safety will be based on financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25%. That can never be below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. Where we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from $7.8 billion in 2013 to almost $16 billion in 2022. The average EBIT growth during this period is 16.3%, meaning a 5% deduction in the margin of safety. The margin has also gone up, going from 31.59% in 2013 to 35.88% in 2022. The average margin growth is 6.2%, which is another 5% deduction in the margin of safety. The next two ratios are the dividend growth and payout ratio. The dividends have gone up over the years, going from $1.40 a share in 2013 to $3 a share in 2022. The average dividend growth during this period is 8.97%, meaning another 5% deduction from a margin of safety. And this with a payout ratio sitting at a very low 28.24%, meaning another 5% deduction in the margin of safety, since we can be certain that they can increase their dividends further, because they have a lot of retained earnings left. The final two ratios that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for Qualcomm, this is just over half a year, in this case a 52% debt to EBITDA ratio, which is really solid and qualifies for a 5% deduction in the margin of safety. And the return on invested capital for Qualcomm is sitting at a very high 37.3%, meaning that the management is very effective at allocating capital, which awards them with yet another 5% deduction in the margin of safety. We're looking very good so far for Qualcomm. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Qualcomm going from 2013 to 2022. The average growth rate during this period in their free cash flow was almost 17%. Now I'm projecting an expected growth rate in their future free cash flow for 10 years of 8%, and with this percentage we'll determine the future free cash flow for Qualcomm and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of $137.2 billion, and to get an equity value we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $164.1 billion. All we have to do to get an intrinsic value out of this model is to then divide it by the amount of shares outstanding, giving us a discounted cash flow price per share of $146.57, which is a 19.16% upside from the current price. The second model we'll be using is the dividend discount model. I've imported the dividend payouts of Qualcomm going from 4 years ago to the current year. The average growth rate in their dividends during this period was 4.94%, now projecting a growth rate in all of their future dividends of 5%. I will once again be using a discount rate of 8.5% in this valuation. This gives us a dividend discount model price per share of $90, which is a 26.83% downside out of this model. The third model that we'll be using is Graham's revised valuation formula. In this model, we'll take a look at the earnings per share that Qualcomm is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory that a company with no growth always is sitting at a PE of 7. And looking at all of these metrics, we get a fair value of $135.72, which is a 10.34% upside out of this model. The next model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to Qualcomm, take a look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 18.94. All we have to do to get a fair value out of this model then is to multiply by the earnings per share that Qualcomm is generating, which is $12.63 a share, giving us a fair value of $239.24, which is a 94.5% upside out of this model. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. I've imported the dividend yield of the past 5 years, and on average this one has been sitting at 2.19%, while the current yield is sitting at 2.44%, indicating that it's currently undervalued on this metric. Doing the same with the PE ratio, the average PE ratio of the past 5 years has been sitting at 22.11, while the current PE ratio is sitting at vastly below this, sitting at 11.78, indicating that it's once again undervalued on this metric, giving them a fair value out of this model of $184.01, which is a 49.60% upside out of this model. If you want to get access to all of the models that I use in my videos and much more, you can check in the description for my Patreon link. Anyways, again, let's start promotion out of the way. Let's go look at the final overview of a valuation next. Looking at our final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $159.11. And a margin of safety we determined earlier, using a standard margin of safety of 25%, deducting it by 5% for the adapt to EBITDA, 5% for the EBIT growth, 5% for the margin growth, 5% for return on invested capital, 5% for the dividend growth, and 5% for the payout ratio, leaving us with no margin of safety at all. Gives it a fair value of once again the same as the average out of all of the models, and with the current price of $123, we get an upside of 29.36%, indicating that's currently a buy. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.